Hello everyone and welcome to GMT Partner video channel. Here you can find some interesting video related to trading and investing on global financial markets. The topic of today's video is triple screen trading strategy. The author of this strategy is Alexander Elder, the world famous market guru, trader, and author of a series of books about stock trading. This strategy was created by Dr. Elder in 1985. It was initially offered to the public in April 1986 in the article of the Futures magazine. I hope this video will be useful to many beginners who are interested in creation of their own trading strategies. It should be noted here that many books by Alexander Elder were translated into many languages and have been sold in many countries. Here is one of his books, translated into Chinese. It's called Trading for a Living. Long time ago, in 1998, it was my very first book about trading. I highly recommend this book to beginners. In my opinion, in this book, Dr. Elder used very simple language to explain the important role of three components needed for the success of any trader: technical analysis, money management, and trading psychology. This is the book where Alexander Elder introduces the trading strategy, which will be discussed today. You can find and download an electronic version of this book on the internet.
Here is the plan of my presentation today. In his trading strategy, Alexander Elder addresses two main problems faced by many novice traders. As you may know, a priority for any trader who uses technical analysis in his trading is to identify the direction of the trend. Many of you have probably heard the expression, "Trend is your friend." Indeed, after defining the major trend, it is much easier and more profitable to trade in its direction. The first problem the beginner may face is that sometimes it is difficult to determine the direction of the current market trend, because the trend can go up and down at the same time. It all depends on what kind of chart you are analyzing at the moment: daily, weekly or monthly chart. In other words, each time frame has its own trend. How can the trader identify the trend, and what direction should he open his positions? There are various techniques and tools used by traders in order to solve this problem. For example, the simplest method is a graphical method. By locating several key points on the chart. When the chart forms a series of rising highs and lows, it indicates the presence of an uptrend. Conversely, if the chart forms a series of descending highs and lows, it indicates the presence of a downtrend. However, quite often, there is a situation when one time frame indicates an uptrend, and the other time frame indicates a downtrend. What is the direction of the current trend in this case? Let us take a look at one example. Here is a weekly chart of a currency pair, Euro-US dollar. As you can see, the highs and lows in this chart are rising all the time. Hence, the trader should move in the direction of the uptrend and be ready to open long position. However, if we look more closely at the chart area highlighted with a red rectangle, by switching to daily chart, we can see the opposite picture. Here, the highs and lows are descending all the time. Accordingly, there is a downtrend on this chart, and if the trader is going to trade in its direction, then he should open short position. Thus, we have a conflict of trend direction on different time frames. This is the first problem the novice traders may face. The second problem is related to technical indicators. The point is, some indicators, used by traders in their strategies in order to define the trend, quite often give conflicting signals. In my opinion, there are three categories of technical indicators, which can be used for various purposes, and which generate certain signals. The first group includes trend indicators, which can help traders to determine the direction of current market trend, Such indicators as moving averages, alligator, Ichimoku, envelope and others, can solve this problem. The second group includes oscillators. Their task is to determine trend reversals. This group includes stochastic oscillator, relative strength index, momentum, commodity channel index, and some other indicators. The third group includes indicators, which solve secondary problems and generate confirmation signals. These include such indicators as volume, average true range, and others. What kind of problem do we mean when using technical indicators? Let's take a look at another example. Here is a daily chart of the currency pair, Euro-US dollar. This chart has two windows. The top window contains a candlestick chart, and an exponential moving average with a parameter of 20 intervals, which is often used to determine the direction of the daily trend. By the way, the moving average shows that the market is developing an uptrend, so, in this situation the trader should buy. The lower window contains a slow stochastic oscillator with parameters of 5, 3, 3, which is often used to define trend reversal on a daily chart. The oscillator indicates that the market is in an overbought condition, or, in other words, is about to reach the top. At the same time, the intersection of main and signal lines, as well as the divergence of the indicator, both indicate a possible end of an uptrend, which in turn gives a green light to trader for opening short position. How does Dr. Elder solve these problems? To answer this question, let's review the trading rules of the triple screen strategy. In developing his strategy, Dr. Elder used the postulates of technical analysis theory, which were formulated by Charles Dow. As you may know, according to Dow theory, there are three levels of trend at any given time on any market. Here they are: the major trend, the intermediate or secondary trend, and the short-term trend. As for the long-term, or major trend, according to Dow theory, it is a trend that lasts more than 1 year. Also, it is a trend where long-term investors are focused on. They do not make a lot of trades, since their main goal is to catch a big price movement. After opening the trade, they do not change the direction of their position, and do not pay attention to the interim price declines. As you know, the market price moves in waves. It never rises or falls in a straight line manner. These intermediate ups and downs, which move against the major trend, are called corrections, and represent an intermediate trend. According to Dow theory, the duration of the intermediate trend can range from 3 weeks to 3 months. Finally, according to Dow theory, a short-term trend is represented by market movements within 2 to 3 weeks. These price movements are of greatest interest for speculators. Their goal is to profit from short-term market fluctuations by making a large number of trades. In his strategy, Dr. Elder brings together different time frames, simultaneously monitors 3 levels of market trends, and takes into account their direction.